Hello everyone. In the last video, we have discussed with regard to the tax implications on long-term shares and mutual fund. But in today's video, we are going to discuss with regard to the tax implication on short-term shares and mutual fund. So this is Abhijith Acharya welcoming you all for today's video, today's session. So if you have not subscribed yet, please subscribe to my channel so that you will get a lot of more update with regard to the Indian taxation system with regard to the shares and mutual fund and also other aspects of our income tax. If you like the video, please press the like button and share the video to the n number of users so that they are also benefited with regard to the same. So welcome you all for today's session. First of all, I would like to discuss with regard to the meaning of short-term capital assets with regard to the short-term shares and mutual fund. Okay. There are three criteria. First, securities listed in the recognized stock exchanges of India. Units of equity-oriented mutual fund. Zero coupon bond. If these categories of shares or mutual fund are held by you for less than 1 year, then these assets are considered to be short-term capital asset. Second criterion, unlisted shares which are not listed in a recognized stock exchange of India. For example, shares of a private limited company. If these shares are held by you for less than 2 years, then these are also considered as short-term capital assets. Third criteria, other than equity-oriented fund, for example, debt-oriented fund. Other assets, for example, units of business trust. If these categories of shares or units are held by you for less than 3 years, then these are also considered to be short-term capital asset. Okay. Now we will discuss on tax rate applicability for short-term capital asset only with respect to the short-term shares and mutual fund. Equity shares listed in the recognized stock exchanges of India, where STT has been paid both at the time of purchase of that shares and both at the time of sale of that shares. Second, units of equity-oriented mutual fund, where STT has been paid only at the time of sale. Third, units of business trust where STT has been paid at the time of sale. Then the tax rate applicability is mentioned under section 111A. That is specified section. This is specified section. At the rate of 15%, no chapter 6A deduction will be available. No rebate under section 87A, even though your short-term capital gain is below 5 lakh rupees. Second, unlisted shares of company, listed securities where STT has not been paid both at the time of sale or purchase, units of debt-oriented fund and units of shares. For these categories, tax rate applicability is under normal slab rate. Then there are some key points which you need to remember before dealing with short-term capital shares or mutual fund. First of all, deduction under Chapter 6A benefit will not be allowable only in the case if your short-term capital gain is specified under Section 111A. If a short-term capital gain arising from which are not taxed under Section 111A, then Chapter 6A deduction will be allowable. But if your short-term capital gain is mentioned under Section 111A, then Chapter 6A benefit will not be allowable for you. Remember. Second, in case of resident individual, if income other than LTCG under Section 112 that we have already discussed, LTCG under Section 112A already discussed in our earlier videos, and short-term capital gain under Section 111A that we are going to discuss in today's video is less than basic exemption limit. That is, other than income specified under this section is less than basic exemption limit, then unutilized basic exemption limit can be used against this income. Okay, this is very important. Third, short-term capital losses are allowed to be set off against short-term capital gain and long-term capital gain, both against short-term capital gain and long-term capital gains. These losses can be carried forward up to the next 8 assessment years. This is the fourth key points. But these losses cannot be carried forward unless and otherwise if you file your income tax return within a due date of filing income tax return that is specified under section 139 subsection 1. That is for financial year 22-23, due date is 31st July 2023. If you have not filed your income tax return within the due date, then these losses cannot be carried forward. In other words, such capital losses can be carried forward only when income tax return is filed within the due date, that is 31st July 2023. This is all theoretical aspects. We will now go into the one practical example so that you will be in a better position to understand these theoretical aspects in a practical way. Mr. Bhima has entered into a following transaction during 22-23 previous year. First, he has sold listed equity shares of some company where STT has been paid both at the time of sale and purchase for rupees 2 lakh. Cost of acquisition is 90,000. Okay. Second, he has sold listed shares of E Limited where STT has not been paid. Remember, has not been paid. In the first, has been paid for 3 lakh. Its cost of acquisition is 1,20,000. He has sold units of business trust, that is infrastructure investment trust, for rupees 3,50,000. Its cost of acquisition is 1,30,000. Fourth, he has sold units of debt-oriented mutual fund for 3,80,000. Its cost of acquisition is 1,40,000. Fifth, sold unlisted debentures of some company for 4,30,000. Its cost of acquisition is 1,45,000. Sixth, he has sold unlisted shares of some company for 4,10,000. Its cost of acquisition is 1,50,000. These are the transactions he has made during 22-23. Here is the question. Compute his taxability for assessment year 23-24 with regard to the previous year 22-23 under both an old and new scheme. Very interesting. Provided his contribution to the PPF, that is Public Provident Fund, and LIC is 1,20,000 and 30,000 respectively. Health insurance premium is 25,000. We'll now compute. Solution for the same. Computation of taxable income for Bima for assessment year 23-24. First, listed equity shares. Sale consideration as mentioned in the question is 2 lakh. Cost of acquisition is 90,000. If you deduct that short-term capital gain will come around under section 111A is 1,10,000. This is considered to be A. This should be taxed at 15% with no chapter 6A deduction with no rebate. Second, listed shares where STT has not been paid. Sale consideration is 3 lakh. Cost of acquisition is 1,20,000. Short-term capital gain taxed at normal slab rate. This is 1,80,000, where you can claim chapter 6A deductions. Okay. Third, units of business trust. Sale consideration is 3.5 lakh. Cost of acquisition is 1,30,000. Short-term capital gain, that is mentioned in section 111A, that is 2,20,000, against which no chapter 6A deductions can be claimed. Okay. This is considered to be C. Next, with continuing with units of debt-oriented fund, sale considerations 3,80,000. Cost of acquisition is 1,40,000. Short-term capital gain tax rate normal slab rate is 2,40,000, against which you can claim chapter 6A deductions. Again, this is considered to be D. Unlisted debentures, sale considerations 4,30,000. Cost of acquisition is 1,45,000. Short-term capital gain tax rate normal slab rate, that is 2,85,000, against which you can claim chapter 6A deduction. Is considered to be E. Unlisted shares of company, sale considerations 4,10,000. Cost of acquisition is 1,20,000. Short-term capital gain tax rate normal slab rate, that is 2,90,000, against which you can claim chapter 6A deduction. This is considered to be F. If you add all these, that is A to F, total short-term capital gain, in other words, gross total income comes around 13,25,000. We'll now compare with regard to the old scheme and new scheme. Under old scheme, gross total income has already computed is 13,25,000, against which you can claim the chapter 6A deductions already mentioned in the question. Contribution to the PPF, that is 1,20,000. Contribution to the LIC 30,000. Under ATC 1,50,000 can be claimed. Under 80D section, health insurance premium, that is 25,000 can be claimed. And hence, total taxable income will come around 11,50,000 under old scheme. If you opt for new scheme, no chapter 6A deduction will come around. Gross total income, that is already computed in the previous question, that is 13,25,000 is a taxable income. This you need to classify whether I go for new scheme and old scheme. Okay, please remember. Now we will compute our tax rate. tax amount under old scheme. We'll first discuss with regard to the old scheme. Mr. Bima has if Mr. Bima has opted for old scheme, then what's the taxable amount? Tax amount. We'll now see. Taxable income is 11,50,000 after claiming the Chapter 6A deduction. First, tax rate is section 1118 because under against which no Chapter 6A deduction will be allowable, flat rate of 15% will be charged against this income. Tax rate section 1118, that is income that is listed equity shares where STT has been paid what at the time of sale and purchase, that is 1,10,000. Units of business trust where SDT has been paid at the time of sale, that is 2,20,000. Total comes around 3,30,000. Other income, balance income, tax rate at normal slab rate, that is 11,50,000 minus 3,30,000, that is tax rate under section 111A, comes around 8,20,000. For the 8,20,000, normal slab rate will be applicable. That is, if you compute the tax applicability, that is total tax come around 76,500. For special section, that is under 111A, 15% on 3,30,000 will be allowable, that is 49,500. Total tax amount is come around 1,26,000. If you add cess of 4%, total taxability is 1,31,040 rupees. Suppose Mr. B has opted for new scheme, then what is the tax amount? Same taxable income 13,25,000, no deduction of Chapter 6A deduction. And the tax rate normal slab rate 13,25,000 minus 3,30,000. 3,30,000 is the section under 111A specifies special section, tax rate 15%. That is come around 9,95,000. That is 3,30,000 is a special section, tax rate 15%. Okay. For 9,95,000, what is the tax amount? If you apply the tax rate applicability that I have already discussed in my earlier videos, that is opting whether you can opt for a new scheme or old scheme. If you have not watched the same, please watch the same. I will also provide that link under this description box. Please watch it again. If you apply the tax rate amount, total tax amount will come around 74,250. Tax amount for 111A, that is 15% on 3,30,000, that's come around 49,500. If you add these two, total tax amount is 1,23,750. If you add the cess of 4%, 4,950 is a cess amount. After adding cess, total tax amount is 1,28,700. If you compare the earlier, that is old scheme, he has to pay 1,31,040 rupees. If he opts for a new scheme, 1,28,700 is a tax amount he needs to, that is Mr. Bima has to pay to the income tax government. He is better in a position to opt for a new scheme. This is my advice. This is today's videos. If you like the video, thank you for watching till the end. Watch till the end. If you are not subscribed yet, please subscribe to my channel. If you have any query with regard to the same, please mail to me or WhatsApp me, as the case may be. And thank you one and all for watching till the end. Thank you.